Welcome back to the Retire While You Work podcast. My name is Carson Odom, joined by Myles Zuger. We've got our first Olympic podcast. Here's to the Olympics being back. My fondest memories of the Olympics are personally for me, Michael Phelps, 2008. That was like, that's just ingrained in me. Watching him win those 8 gold medals was awesome. I'll never forget that. And then over the years, my other favorite memories are Shaun White on the half pipe. Those are probably my 2 biggest memories of watching the Olympics growing up.
I do enjoy having the Olympics on at night. I think I've realized I'm more of maybe a summer Olympics person though. Like, I don't know. The Winter Olympics are great, but I find myself being way more into the Winter Olympics or to the Summer Olympics. But I do like the event, like what's on in the background. I think it's called the biathlon, where it involves like cross country skiing and shooting targets. I think it's pretty incredible, like what that probably takes to be accurate when your heart rate's up that high. And then like last night there was some speed skating on. There was some woman from Italy. It was like her 6th Olympics, which is insane. Which puts her back at like I think maybe the 2006 Winter Olympics would have been her first one.
Wow.
Which is pretty crazy.
That is.
To think about awesome. Going for that long.
I mean, it's. Obviously there's the country and the pride in your country that you've got athletes from across the world competing, and you love your country, you want your country to win. And then there's the other part of that, which I think is what I enjoy watching is it is a lot of individual sport and like a lot of individual training. There's obviously group training, but it's not like for the most part, it's not like a 12-person football team. And this, I feel like there's a lot of cardio endurance with a lot of Olympic games and a lot of Olympic sports. And I think that's what's awesome to watch is watching people train so incredibly hard. And it's a absolute mental battle, and it's all endurance and cardio and pushing themselves to the extreme. And that's exhilarating to watch. That's encouraging to watch. Yeah. That's like, as you're sitting on your couch watching your TV and it's like, what am I doing? These guys.
I mean, one of those speed skating events is like 500 meters, which I think it's only like a couple times around the track. And obviously, like to your point, obviously there's like the world championships that they have every year, but like, and they all care about those, but obviously the Olympics are like the pinnacle of it all. And so to think about like these people just training like for 4 straight, like after this, they'll start training for assuming they're trying to make the next one. They're not like retiring, but they will train just for 4 years in the hopes of making it back for an event that lasts like, I think like 45 seconds. It's crazy that they, I mean, kudos to them. It's dedication for sure.
Kudos to them. And a lot of these people have jobs outside of this. Like this is extracurricular. Like I feel like the curlers were for curling for Winter Olympics. They were talking about how they're not just professional curlers. There's unfortunately
there can't be a lot of money.
Big incomes there.
Yeah,
that's right.
So maybe I feel like at the peak of the peak, like the top like 3 people in the sport in the world might be able to do that for a living, but everybody else probably not.
I agree. It's awesome. I love watching it. This is historically, I feel like this time of year post Super Bowl, there's always a lull in sports where it's like, man, football's over. You don't have the Thursday, Saturday, Sunday, Monday night, football going on between college and professional, but it's this carries you through February, gets you to March Madness, college basketball. Then you've got baseball kicking off, some PGA Tour events with the Masters in April.
The Masters in there.
It's coming soon. Yeah. The Olympics helps the lull. But anyway, on to market related things. Myles and I just wanted to kind of chat through a little bit of what's been going in the stock market this year. We'll keep this episode relatively high level and pretty short. And it's been volatile. There's been plenty of up and down days. The market's roughly 5. That just gives overall picture of how the indices are performing. Let's see here. Let me make sure I get the right slide in here. There we go. So if we look at this chart, so the NASDAQ, this is as of close of business yesterday, I believe. NASDAQ is flat for the year, up 0.3%. And the S&P is up a couple percent, right? Floating around all-time highs. But I think what speaks volumes is all the other major indices are outperforming the S&P 500 and the NASDAQ. We've got the Dow that's up 5%, the S&P 500 equal weight that's up over 6%, which has not been the norm, followed by small caps up 8%, international markets up 9%, and then emerging markets already up almost 11% for the year. And that's coming off of a strong year in 2025. So this year, we spoke about this really through April, May of last year. It was the tale of other asset classes other than the United States are performing extremely well.
Yeah, I mean, you definitely started to see some broadening out, which I think, again, you saw some of that early last year, and then it was like we had the market drop 20% in March into April, and then from then on, it was the tech stuff that really ran up again. It's kind of a similar story this year in that everything but technology is what's performing well. I mean, like you said, it's broadening out amongst the equal weight S&P, some of the international type stuff continuing to do well, and so I think this is positive to see, because I feel like you maybe, if you're somebody who watches financial news or maybe just the news in general, you see all the negative talk about stocks being down. And yes, there's a lot of stocks that are down, but it's a lot of the technology stuff that had really run up last year was sitting at record highs. Everything else, because even in a year like last year, the market finished up 15-16%. There's probably, I don't have the exact numbers, but there's probably, I don't know, 200 and some odd stocks that were negative on the year in the S&P 500. So let's just say half of the S&P 500 is up, half of it's down. But because those bigger stocks did well, it finishes up 15-16%. Now you're seeing those other names that maybe didn't do so well last year starting to have better years as things broaden out, which then can drive performance across the rest of the S&P. And that's when I think diversification, which is something we preach with all of our clients, becomes more important. You don't want to be concentrated in the top 7 or 8 stocks because you really feel it during the downturns. But if you're diversified and in a bunch of other great names also during those times of downturn, you either, one, maybe the whole market's down and you are feeling it, but maybe not as bad, or you can actually be up a little bit more than what the market's up to start the year like we are this year.
That's exactly right. And, we have allocations in our client portfolios to international stocks. We have allocations to emerging market stocks. So those are 2 indices that are up 8, 9, 10% so far this year. Do we have massive weightings there? No, because just because they're doing well this year, there is a lot more volatility there, and they've underperformed historically for a long time compared to the United States. So again, this is just a picture of it screams the importance of diversification. We're not going to know which asset classes and which indices are going to outperform in a given year. We have tons of research that we follow that has best guesses based on their analysis. But no one can predict this. We're all living the same life. We all take data and analyze it the best that we can to make relatively solid predictions on how the market's going to perform and where's the best sectors, where's going to be the best asset classes to be in. And since you don't know, that's why diversification is absolutely key. And that's why it's working. It is working so far this year. What's been interesting so far this year too is over the past couple of weeks, there was a lot of volatility in the stock market, where I think it was the first week of February, where there was a kind of a big sell-off for, I don't know, market might've been down within a couple of days, 3-4%, maybe 2%.
Yeah, I think it was it was like a little over 3%. It was down across the first couple of days of that week,
which is the latter half of this chart. So what this chart's depicting is, first we've got the S&P 500, followed by depictions of Adobe, Workday, Salesforce, Intuit, and Monday.com, their stock prices and how they performed so far this year. Adobe down 23% this year, Workday down 28%, Salesforce down 28% this year, Intuit down 37%, and Monday down 52%. Just for this year. I mean, we're 6 weeks into the year, while the overall S&P 500 is flat. What's the why here is it's all AI driven. It's all the fact that it's not that, Salesforce and their massive CRM moat that they have around themselves is going to go away tomorrow, but it's all of the view that all of a sudden AI is becoming this player that it can replace software. That is the overall thought, that it's not that Salesforce is going to be gone tomorrow, but 10 to 20 years down the road, where is Salesforce going to be? And that's kind of the volatility in what struck over the past year. weekend
Yeah,
market.
and I think if you're somebody who is maybe listening, maybe like you're more of a stock picker, we're like, oh, this is could be a great opportunity to buy some of these stocks when they're down 20%, which historically is true. I think as you think about AI and what that can do, I think you really have to think, can or will AI disrupt things, or will AI disrupt things enough that maybe the same valuations we've used in the past on these companies aren't the same, and you kind of have to re-underwrite the whole thesis on some of those companies. But then there's other companies that aren't even public right now traded that have low valuations that somehow someday will be sky high because they're going to replace some of these things. So I think it's just an interesting time, especially as AI continues to, I think I can speak for us at least. I would say we're all starting to use it a lot more and more for various things, various applications, both personally and on the business side of things. And I think it's changing things at a rapid pace, probably faster than things ever have before. And who knows like where it goes, but it's certainly going to replace some companies. But that's not to say those companies that Carson just showed there won't figure out how to adopt AI into their business, and then it changes their whole model and whatnot. So I think things are just moving so fast. It's like, how does this fit into everything exactly? And then that's what we're all trying to figure out.
Yeah, it's I heard some commentary about Salesforce specifically of before this kind of market decline, their share price declined. They were trading at price to free cash flow around 30 times. So in what you could say there is you've got 30 years of cash flow that you're trading at that the market was previously expecting. That was the valuation it could get. We have confidence in 30 years of their cash flow. Now it's been cut in half, essentially, that valuation. Again, it's not that Salesforce is going to lose in a CRM software is going to lose their moat of their ability to perform in cash flow over the next 5, even 10 years, but it's really over the long-term trajectory. How is AI going to change these businesses when, I don't know, when it comes to PDFs, you need to edit something in a PDF. Instead of using Adobe, do you go straight to an AI software, ask it to do it for you, and then you don't even have to do anything? And then eventually you ask for an AI software to make a PDF for you, like, hey, make an agreement for me, generate a PDF and send it to me. Okay, done. And that had zero reliance on Adobe, Again, not saying that.
I guess because the two big concerns that come to mind there are maybe like privacy, like what is the security around these things, and accuracy. Like if you're creating I don't know, think of like some sort of contract you're creating for yourself or for a start or something like that, and it's
Medical records.
medical record. Is it 100 pages long? And are you really going to go? I mean, I think you have to go line by line to make sure that everything is exactly how you want it to be, because maybe it's something you hope you never have to use, but if you just sign it blindly and then that's what you're using, and then something happens and you need that medical wise, estate planning, wills, whatever it might be, and it's just wrong, like
Download it, upload it to
yeah,
a different AI software, and ask it to proofread it for you.
I guess you could do that. There's
Um,
one route you could go, but yeah, I think that's my biggest thing with all of it is just like haven't quite leaned into the trust behind just like being like, this is 100% accurate, and I think that's
mhm.
good. I'd rather be on that side than just blindly trusting everything.
Yeah, especially at this day and age. I've heard, I think it was Elon on a podcast talking about one time when it comes to Tesla and why the push for full autonomous driving and full self-driving. And he made the analogy of he's trying to take as much human decision out of the equation, because human decisions are what cause accidents or what cause wrecks. And if you have just a street full of autonomous vehicles operating, computers in their code, how they're written, they don't make mistakes. I mean, yes, there can be errors in code, and sure, there can be issues and bugs with software, but once that's fixed, patched on a high level, computers are just a set of rules. They don't make mistakes. They're not going to get over whenever there's a car in their blind spot. They have cameras. They just don't make that mistake. So I get where it's like, if we can eventually get human intervention out of simple tasks, then that can only improve their efficiency, improve their accuracy, you would think. Now, obviously, I get the skepticism of wanting here to, you don't want to sit here and trust it with everything. And I agree. Like whenever we do any sort of research here at work, run through all the sources and then also vet everything that AI might have produced for ourselves to make sure it's 100% accurate. But I mean, I can say my experience, I feel like me, you, Miles, we're heavy users of AI in our daily lives, probably personal and professionally. There's not a lot of errors that trust. There's not a lot of like, oh, it spelled it wrong. Probably not.
Are you just saying everything I just said was just not accurate then?
No, no.
I'm just kidding.
Because I agree with you, especially like we ran through it this week. We were uploading some sort of agreement and it got some numbers wrong, and it might have been just how we dictated to it what we were asking it to do. It misunderstood, but again, that's because of maybe we prompted it incorrectly. But yeah, there's a huge concern on making sure everything that you're using is valid and accurate. But I think
The one thing I will say is it is crazy how quickly it gets better. Like I think about when we started using some of the tools like a couple years ago, and it was like, maybe it was 2025. Let's say it was like early 2025, and it couldn't pull data past like 2023. And now it's like, I know we're a couple years out, but it's like the data that it's pulling is from 10 minutes ago or like yesterday. It's like much more accurate. And so this is like, I remember an economist said probably, I don't know, 4 or 5 years ago, he said, this is at the time he said, this is the slowest or the fastest technology's ever moved. And it's also the slowest it will ever move. And now I think about all the tools that we have in today's world. And I mean, that's more true. And then it's like you have Elon talking about robots and autonomous cars and the way he's shifting his companies. It's, yeah, I mean, that just feels like the most true statement. And I don't see it changing anytime soon.
I would recommend if you are someone that has been a part of, you've tried to experience some sort of AI chat, or you picked it up and used it 2 or 3 years ago and you didn't think it was that impressive, I would encourage you try it again, because over 2 or 3 years, that's like an eternity in the realm of how fast AI has evolved since its creation. I think ChatGPT came out in what, 2022, and maybe early 2022. But since then, it's astronomical how fast it changes and how much better it gets over time. So if you're a user of AI, I would encourage you to continue to do it, continue to dive in and see how it applies and can improve some efficiencies in your life on a personal level, but also on a workplace level. The only other comment I had, unless you have anything, Miles, was I had just an interesting chart that I saw that was released from BlackRock over this past week. So again, shifting gears a little bit, talking about housing in general. I do feel like housing's in a little bit of a pickle. We all experienced 2020, 2021, where it was some of the fastest year-over-year changes in housing prices across the entire nation. Everybody wanted to buy a home. We had 2 to 3% mortgage interest rates, which is so insanely cheap when it comes to purchasing a house. So I wanted to bring up where we're at with the age of home buyers. Currently, the age of first-time home buyers or historically, I'm sorry, first-time home buyers has hovered around 30 years old. So you have late 20s to early 30s. Fast forward to now.
This is all just like, just so I understand this, dude. This is all just like current ages. Or no, I see what it's doing. It's tracking back. Okay, I'm with you.
Yep. So the chart's depicting of different
since
ages of different
since 1982
home
on.
Since 1982 until 2024.
Yep.
And you've got a list of the median age of all home buyers, the median age of a repeat buyer, as well as the median age of a first-time home buyer. So the median age of a first-time home buyer has gone from 30 just 10, 15 years ago. Now it's above 40 years old, your median age of your first-time home buyer. The average age of all home buyers was in the 80s, was around 32, 33. Now we're at almost 60 years old for the median age of all home buyers. And I think this is depicting where we're at and the issues that we're having with housing. Is it's not necessarily getting houses to move. I think it's more of getting first-time home buyers back in the stock market, because you've got these massively inflated home prices, and now you have really, really high interest rates relative to where we were, not necessarily in the grand scheme of things, but relative to where we were 4 years ago, 5 years ago. And that is a recipe for it's extremely difficult to get into your house for the first time.
When I look at it, and then I think about kind of an internal discussion we had here on Monday, and it's like I think
Oh yeah.
if it, if like owning a house is great, but I think also maybe in Middle Tennessee specifically, also we saw like from 2020 through 2022, where like housing prices just skyrocketed, and if you owned a house, it was like for most people the best single investment they've ever made in their lives, and
Just because of the appreciation.
just because of the appreciation. And it didn't really matter like what you owned. It was like it was all up X%. But outside of that, like if you're just in a normal housing market, and let's just say your house is appreciating by 3, 4, 5%, when you start to add in like, I mean, we just had a huge ice storm here. So when you add in like damage people are having to cover at their properties for that, even if you're having to, pay a deductible, you figure in interest costs, property taxes, other just like general home maintenance it takes to, keep your house from falling apart. Over long periods of time, I think it's like somewhat of maybe a break even. And people could challenge me on this, but I think when you add in all those costs, it's not quite the investment people saw. And yeah, maybe you bought a house, and you sit in it for 10 years and you make a couple $100,000 more than you paid for it. But then we start to add back property taxes, other maintenance, other work that you had done on it, just general upkeep, it starts to bring that number down some. So I think I say all that to say, if you're somebody who sees that and you're like, I'm 25, I'm never going to own a house in my life. I'm like, don't freak out about that. It is a place in time right now where it's okay to rent. It's cheaper to rent right now, and you don't have to worry about anything. I mean, if you were just like renting a house and we had that ice storm and a tree fell on it, call your landlord, go find yourself a new place. Like you're out of there. There's nothing. They're probably going to let you out of your lease. There's nothing for you to worry about. So it's like there's give and takes, but I do think outside of the massive appreciation we saw over a 2 or 3 year time period, owning a home maybe isn't. And I'm a homeowner, full disclosure. It's not everything is chalked up to be. And I say that thinking like with some of the stuff I've had to put into my house, I'm like, man, if I just didn't own this house, like I wouldn't have to spend that. But then you do give up the ability to kind of make it your own and paint walls and do things.
There is. And remember your mortgage payment, you are paying down principal. So you are applying a payment each month that is going towards the equity in your home. You're paying off a loan. But again, if you're structured on a 30-year mortgage, you're hardly making a dent in that principal those first 5 to 10 years. And if it's going to be a short-term spot where you're going to build a home, all you're doing is paying interest those first few years. It's not like you're building massive amounts of equity by paying down the principal. But again, full disclosure, homeowner. And I think I would be regardless of if you tell me I can expect 1% of appreciation. Okay, that's fine. I'm probably still personally going to own a home only because I like the idea of there's a lot of value to making it my home, personalizing it, doing some sort of remodels, additions to it if I wanted to, and really planting my feet down of where I want my family to be. That's not everyone, especially if somebody's in transition, moving. I think renting is one of the best choices you can make. But yes, I think bottom line, what we're trying to get out here is it's okay to rent. There's with where housing is at, how expensive it is. Do not feel like you are all of a sudden behind everyone else just because you're renting and you don't own a home.
Yep. Without a doubt.
Without a doubt. Yep. All right. Off to watch more Olympics.
I would be curious too, for anybody listening, if they want to give any feedback out on this podcast, I would maybe ask. These market ones aren't something we do super regularly, but I think we both enjoy doing these. And we're maybe trying to figure out how to incorporate a little bit more market talk into just kind of our regular marketing activities that we do. So if anyone wants to give feedback, whether you like these, you don't like these, you kind of like the direction of us,
what you want to learn about, if there's something specific we can teach on,
whether you like the market talk or maybe more the general financial planning type stuff that we're doing, we're always open to feedback, trying to make this the best for listeners. So we're open to that, and give us a shout.
I like it. That's a good call. Well, thanks for joining us on the Retire While You Work podcast, and go Team USA.
Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. The information contained in these podcasts do not purport to be a complete description of the securities market or developments referred to in this material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Every investor situation is unique, and you should consider your investment goals, risk tolerance, and time horizon before making any investment. Prior to making an investment decision, please consult with your financial advisor about your individual situation. Any hypothetical examples are for illustration purposes only. Actual investor results will vary. Raymond James does not provide legal or tax services. Please discuss these matters with the appropriate professional.